Hi guys, it's Chris Wong here. For this video, I'd like to talk about why I hold USD funds in my TFSA account that pay monthly dividends. As a disclaimer, I'm not a financial advisor. I'm just a guy who's interested in building a portfolio. So holding USD funds that pay monthly dividends in the TFSA, there's a 15% withholding for Canadians. So every time you get paid a $100 dividend, each month you have to pay $15 in withholding tax to the IRS. So you won't get those $15 back, and even the TFSA, you still get taxed on that part. The rest of the income is tax-free. I watch a lot of passive income investing videos, and he's a big believer of using the RRSP to hold your USD funds, which I do use in order to get the monthly dividends, because the RRSP allows getting the full USD dividend per month or quarterly and not have the withholding tax taken off. So in the compound growth, it actually adds up over time. So in that same scenario, you get $100 a month in the RRSP and dividends. No $15 taken off of that. And then over a period of time, that adds up. That's extra shares. Like $15 can add up to like one share of a good USD fund. In my TFSA, I find that having some USD funds, I do like having some really high yield dividends. And I found that some of the USD funds, their dividends are much higher than some of the funds I found in Canada, especially if you use defined funds like QQQY, JEPY, and IWMY, and even some yield max funds as well. But in my own personal TFSA, I use mostly just QQQY, JEPY, and IWMY for the high yield funds, and I reinvest those dividends into HYLD.U. So HYLD.U is a Hamilton covered call ETF that's based on the entire US market, and it works almost the same way as HYLD.TO, except the currency is different. And because HYLD.U is listed on the TSX, there's no 15% withholding tax on it. So I find using the dividends from those three Defiance ETFs, I can use that to build my HYLD.U, and then over a period of time, I should have a bigger portfolio in USD in my TFSA, and not having it taken 15% off every single dividend off HYLD.U. So one of the reasons why I hold funds in my USD account for monthly dividends, even though there's a 15% withholding tax, is because I just take the money out easily, and I don't have to worry about what goes in my taxes next year. I don't worry about the disadvantages of withdrawing from RSP early in life. I'm 36 years old right now, so it's more beneficial for me to take out RSP when I'm closer to retirement, or even in my 50s, when I can actually take advantage of the RIF. Now, I don't fully understand the difference between a RIF or RSP at this stage yet, but I had a feel because the RSP is going to grow for at least 20 years before I ever consider withdrawing from it. So it's probably going to cost me more money to withdraw from RSP now than the feel of withdrawing from, say, RSP or RIF in 20 years. Now, having a higher balance of JEPY, QQQY, and IWMY sounds risky to some people, but it is a risk I'm willing to take. And the reason why I'm willing to take this risk is because a lot of people that I found on YouTube who actually invest in them, they actually invest a bigger portion of their portfolio into them. And because these funds are based on the indexes, compared to like yield max, which most of them are based on just single stocks, as long as it's based on the index, they kind of go up and down with the markets. In the long term, I'm trying to build HYLD.U. And in the long term, if the portfolio for the HYLD portion gets bigger, then over time, I would feel more comfortable to withdraw the entire dividend of HYLD.U on a regular basis if I decide to use it on a regular basis. compared to JEPY, QQQY, and IWMY, withdrawing the entire dividend every single month in order to live off of later in life. It's not something that's sustainable because the dividend yield is so high that the fund needs to have reinvestments in order to sustain the portfolio value. So far with Canadian ETFs that I do invest in, the highest yield I found so far is around 18%. And that depends on what the fund is. So the one I found that was around 18% is Horizon's leverage version of ENCC called ENCL. And it's based on oil and gas. And because it's only based on the oil and gas companies, so it only covers one sector. So it's not an index-based fund that I would put a lot of my portfolio percentage in. I actually put some of my funds in the non-registered account as well. The exact same funds, QQQY, JEPY, and IWMY. And I found out that I had to pay some taxes on it. And the only way I found out is because when I was filling out the information in the tax program, I was using Wealthsimple Tax. I found out that whenever I put the foreign dividend income in from those defined funds, it actually lowered the refund a bit. So that means if I was paying taxes already, then I would actually pay more taxes. So even though there was a 15% withholding tax and there was a foreign tax credit, there was still seems to be like some tax to pay on top of that. So I have a better feel for having some defined funds or some other USD funds in the TFSA. It doesn't mean that I just hold all USD funds in the TFSA. If I think the funds are more risky, more volatility, I would actually hold them in the non-registered account. It's just that the three defined funds are based on indexes, so I myself feel comfortable to hold them in my TFSA and my RSP. I hope you all appreciate this information. If you liked the video, please give me a thumbs up. Otherwise, please subscribe to my channel for further videos updates. Thank you guys for watching.